Hello from Riyadh during this coronavirus pandemic days. My name is Partha Majumdar. I recently faced a problem from one of my cousins who is retiring from an organization, a big organization in Saudi Arabia. Now, he has not planned anything for his pension after retirement, and he is due to get a big amount of money. And he faces a challenge that he requires a regular monthly income after he goes back to India. Okay, he has got some investments in fixed deposits, etc. However, these are blocked and these cannot be withdrawn immediately, and this will not give a monthly income to him once he returns to India. So his problem is that he requires a monthly income once he goes back from Saudi Arabia to India very shortly, so that he can spend his life in relative peace. He has a figure in mind and he told me to plan accordingly. Also, he gave me a figure as to how much he is expecting to get from his retirement benefits. So, while solving this problem, I realized that this could be an issue with many people. So, after having solved the problem for him, I thought I will share the technique I used and the solution I used so that it could possibly benefit other people as well. So, the same is presented in this video. So, the problem is that we would like to plan for a monthly pension based on the fact that we have a corpus with us which can be used to generate the monthly income. Now, the monthly income should be sufficient for leading a peaceful life. So, let's see how we could do this. To plan for a monthly income based on a corpus, the first thing we need to do is we need to choose the instruments which we can possibly use for generating this monthly income. Now, there are many instruments, however, I am not aware of all of them, and I am aware of a few which I present to you. It could be prudent that you could search for more options based on advice from bigger financial experts. However, these are options which are available to everyone, and I will tell you the pros and cons of each of them. The first one we discuss is a post office monthly income scheme. This is the option which is available from Indian post offices for all Indian citizens. I'm not aware whether this is available for foreigners in India as well. The second option is we can plan to invest in annuity plans. The annuity plans are provided by LIC and other life insurance companies in India. Annuity plans are basically plans in which we put a lump sum at one point of time in a single payment, or there are also options where we can pay multiple payments, and these plans can start generating monthly pensions or monthly annuities immediately, or we can also defer it. We can say, okay, fine, start the annuity from 5 years or 10 years, etc. Then the third option is we could make fixed deposits in banks. Now, the fixed deposits in banks have option that we can withdraw the interest what the fixed deposit generates every month. So this is the option which can also provide a monthly income from a lump sum which is invested. And the last option we will discuss is some mutual funds. There are mutual funds which provide the dividends on a monthly basis. So getting the dividends from a mutual fund on a monthly basis can generate a monthly income. Now, like I told you, there are other options. I personally also use other options which are slightly different from the situation because they require an investment prior to the start of getting the annuities. So that is different from the situation where we have to start making the investment now and start getting the annuities right away. So that's why I will not discuss those options in this video. So let's go through the first option, that is investment in post office monthly income schemes. Now, this is provided by Indian Post, and this can be availed from any post office in India, and this can be transferred across post offices in India. So there are a lot of flexibilities now as compared to the earlier days. However, there is a limitation that we can invest maximum 9 lakh rupees in this scheme for a couple. Now, the option is that we can invest in this scheme as an individual or with a joint account held by maximum 3 people. Now, if the account is opened in an individual's name, we can invest rupees 4.5 lakhs. If the account is opened in a joint mode, there can be at the most 3 joint holders of the account. The maximum amount that can be invested is rupees 9 lakhs. So now, if we have a couple, so either you do it in an individual manner or you do it in a joint manner. The maximum amount that you can invest is rupees 9 lakhs in this scheme. The advantage of this scheme is that the interest rate is relatively higher. I will discuss this interest rate slightly later when I show you the calculations. But you can take it from me that generally the interest rate is slightly higher as compared to the other instruments that we will discuss. And the most important thing about the post office monthly income scheme is that as this is a scheme operated by the government, there is almost a zero risk. Now we must note that when we say relatively high interest rate, we should be clear that we are talking about other instruments which also have a relatively low risk. If the instrument has higher risk, the possibility of getting a higher return is always there. But the risk could also lead to the fact that there could be a crash of the corpus that we have spent on that particular investment. So another advantage of the post office monthly income scheme is that it is non-taxable. So all the returns that you get will be not taxed by the government. Another major feature of this monthly income scheme is that we can discontinue the scheme at any point of time. However, if you discontinue, I believe less than 3 years from having opened the account, then the post office will charge you a discount rate, that is a penalty of about 2% from the principal amount, and return the balance amount to you. However, if it is continued for more than 5 years, definitely there is no charges if the scheme is discontinued by the investor. The problem with this scheme is that there can be operational hassles. Okay, operational hassles are much lower today in India as compared to earlier days. The problem is that for getting the monthly returns, person had to go to the post office and wait in the queue to withdraw his amount and then come back. Nowadays, the post office has mandated that the investor needs to definitely have a savings account with the post office before any investment can be made in the post office. And then the monthly incomes are directly credited to the savings account. Further, in all major cities, the post offices have got their own ATMs. So, in at least the major cities, the investor can use the ATMs to withdraw the money whenever he wants from his savings account. So, the operational hassles are relatively lower nowadays compared to earlier days. However, operational hassles with this investment type is definitely much higher as compared to the other instruments that we will discuss. The second instrument that we discuss is the annuity plans. Now, annuity plans are provided by any life insurance company. In India, the biggest life insurance company is Life Insurance Corporation of India. There are private life insurance companies as well, like HDFC Life, etc. Generally, the interest rate provided by Life Insurance Corporation of India is slightly, very slightly higher than the interest rate provided by the private companies. The annuity plans can be invested in two manners. Only one of them apply in our case. The first way is that we invest a lump sum in the annuity plan. That is, we make a one-time payment in the annuity plan and we start getting the monthly pensions or quarterly pensions or annual pensions against that amount that we have invested. The other option is that we can pay the amount of the investment over a period of time, let's say 5 years or 8 years or 10 years, and then after the end of the payment term of 10 years, the amount starts providing a monthly income or a annual income or a quarterly income. Now, the option we're talking about is that we want to invest one time in this annuity plan and start getting the monthly payouts. In this case also, when we make a single payment to the annuity plan, we can say that we want the monthly payouts to come from the next month itself, or we can say that start making the payments after a period of, let's say, 5 years or 3 years. So that is also possible. Anyway, we have to concentrate on our problem that we want the monthly payouts immediately and we will make the investment only once. That is, we will make the investment right away. Now, in the annuity plan, we can say that we want the annuity plan to only cover the life of one individual, or we can say that it can cover the life of the individual and his spouse. Let's say the annuity plan is made in the name of the husband, so he has a choice whether he wants to cover only his life or he has a choice whether he wants to cover the life of himself and his spouse. In case he covers his own life, then the monthly pension or a monthly annuity will be paid till he is alive. In case the policy is made in the name of the wife and the husband is also made as a beneficiary of the policy, or the other way around, the policy is made in the name of the husband and the wife is also made the beneficiary, then the monthly annuity will be paid till the primary annuitant, that is either the husband or the wife, is alive, and after the demise of the primary annuitant, the secondary annuitant will continue to get the pension till that person is alive. So, if the policy is made in the name of the self and the spouse, then till both of them are alive, the same amount of pension will be provided to both of them on a monthly basis. Now, like I'm repeatedly telling, the pension can be withdrawn in a monthly manner, or it can be withdrawn every quarterly, or it can be withdrawn half yearly, or it can be withdrawn annually. So these options are also there. However, we are talking about getting a monthly payment, so we will concentrate on the monthly payouts. Another option is that we can tell the insurance company that I am putting this amount of money, give me a monthly payment. However, after the demise of both the annuitants, in the case of the policy being made for self and spouse, the principal amount should be given to the nominee. Say, for example, you invest 50 lakhs in an annuity plan and tell the insurance company that give me a monthly pension to me and my wife till both of us are alive. So they will calculate that, and At the end of the death of both the husband and wife, the principal amount of 50 lakhs will go to the nominee, maybe the son or the daughter. So this option is also there. However, you must remember that if the policy is made on one life, the amount of pension provided by the insurance company will be higher as compared to if the policy is made in the name of the self and the spouse. Further, if the policy terms are that the pension should be paid to the self and spouse and the principal amount should go to the nominee, the monthly pension will be even lower. Okay, the advantage of this is that if you do this annuity plans from LIC generally will cover the complete life of the person from the day the policy has been made. The private companies generally have a condition that they will give the pension for a defined period of time. Normally, normally they say that the pension will be paid till the person attains the age of 99 years. So one must be careful and read this clause while making the annuity plan. Now, like I told you, we have an option in almost all the annuity plans where the principal amount may go to the nominee. So this option can be opted for by the person who is making the investment. Now, the interest rate is generally lower, and the interest rate becomes further lower when we calculate the net interest rate from such annuity plans. This is because of the benefits it gives. Like, for example, if the principal amount has to go to the nominee, obviously the net interest rate will be much lower because the principal amount, whose future value is going to be quite less, but it will be paid out to the nominee. So, this is a negative side of such plans. But these annuity plans, especially if it is made from a government agency like Life Insurance Corporation of India, the risk factor is very low, almost nil. And now LIC has made quite elaborate digital infrastructure by which these payments of monthly annuities are credited directly to the bank accounts. So there is not much hassle in terms of getting this money. But there is a requirement in the annuity plans that maybe after every 1 year, or in some policies after every 5 years, the annuitant has to submit a life certificate which should be signed by some bank officers or some gazetted officers stating that the person is still alive, and based on receiving the certificate the annuity will continue for that person. This income from the annuity plans is non-taxable as of now. The law may change in the future, but as of now this income is non-taxable. Now, there are some annuity plans which provide for no exit plan if the investment is made in these annuity plans. So once you invest, you are locked and you have to go through the complete term till your death for the benefits or the returns from these policies. However, there are some annuity plans, like for example, Jivan Shanti, which is going to be discontinued very soon from LIC, which provides the option that the person can exit the plan if he thinks he no longer wants to continue with the plan. So one needs to be careful and find out what is the exact option provided by the annuity plan. The next option for getting monthly annuities that we discuss is putting money in fixed deposits and withdrawing the interest on a monthly basis from the fixed deposits. Now, this instrument is provided by all the banks. So, in all the banks, when you make a fixed deposit, there's an option whether you want the interest to be paid at maturity, or you want the interest to be paid every month, or you want the interest to be paid every quarter. So, these options are there. So, we can apply the option that we will make the withdrawal of the interest generated by the fixed deposit every month. Now, when this is done, the bank pays out the interest every month. However, the principal amount which was deposited in this fixed deposit remains intact. So, at the end of the term of the fixed deposit, the principal amount comes back to the person who made the investment. The problem with fixed deposits is that generally the fixed deposit can be booked for a maximum of 10 years tenure. So after 10 years, the fixed deposit will definitely mature, and if this instrument has to be used, the person has to make a fresh fixed deposit under the same kind of uh, scheme that he is planning to withdraw the money from the fixed deposit with. Now, the fixed deposits generally have a lower interest rate as compared to the other instruments that we have been discussing. And another point to note is that after 10 years, if the same fixed deposit is created once again with the option for monthly withdrawal of interest, the rate at which the fixed deposit is made today will be higher as compared to the rate what it will be 10 years later. So after 10 years, when the fixed deposit is made once again, the returns from the fixed deposit will be lower as compared to what it will be today. This is generally the case. I have not seen too many times when the rate of fixed deposit has increased uh, after a certain period of time has lapsed. Of course, this happened sometime in 2007, 2008, 2009, when fixed deposit rates increased and went up to as much as 10%. But in general case, we can say that over a period of time, the rate of interest on fixed deposits will reduce. Fixed deposit incomes are taxable, and the tax is also deducted at source by the banks who provide this instrument. Generally, we can say that this is a low risk option, especially if the fixed deposits are made with reasonably big banks. However, the risk is always there that the bank may default and the bank may declare bankruptcy. In that case, we can have a very heavy loss. Now, say for example, you deposited 50 lakhs in a fixed deposit and the bank defaults. By law, the bank is only liable to pay you a maximum of rupees 1 lakh as compensation in that circumstance. So you can have a very big loss in case the bank defaults. So this is a risk which this instrument carries. The advantage of fixed deposits is that we can exit from this at any point of time. At any point of time, we can exit. Generally, nowadays, there is a penalty clause if the exit is made, in which maybe 1% or 2% of the principal amount is deducted as a penalty fee. But there are many options where this penalty fee is not charged as well. Then there are different kind of customers. Supposing you are a premium customer, then you may not be charged penalty, even if the same penalty rate is applicable for other type of customers. So this is something which you can check it out. The last option that we discuss is the mutual funds option. Now there are mutual funds which provide dividends on a monthly basis. So first of all, we need to invest in the mutual funds in the dividend option. And second, under the dividend option, we need to choose the dividend payout option. And we need to find out whether the mutual fund pays the dividends in a monthly manner. Now, the mutual funds which provide dividends every month are called the balanced funds. So the balanced funds, they provide the dividends on a monthly basis. The dividend rate is generally fixed. Like for example, there was a mutual fund from HDFC mutual funds called HDFC Balanced Advantage Fund. Now, for many years, this fund has been giving a dividend on a monthly basis of about 1%. The amount was fixed, that is 0.31 rupees per unit or 31 paisa per unit. But then this coronavirus pandemic started and the economy had a fall. And so this particular mutual fund has reduced the monthly dividend from 31 paise per unit to 23 paise per unit. So the dividend rate, though generally constant, can change based on the market conditions. Now, the advantage of mutual fund is that over time, the mutual fund may appreciate. So it is possible, in spite of giving dividend on a monthly basis, an investment of 50 lakhs may become 55 lakhs or 56 lakhs or 60 lakhs over a period of 5 to 6 years. So this is a possibility, but this cannot be taken as granted. It is also possible that it works the other way around, where a 50 lakhs can become 40 lakhs or maybe even less than that. So that possibility also remains with the mutual funds. So mutual funds is a relatively high risk instrument. So one needs to be careful with this. Now the risk you take is the reason why the returns are also higher. The risk becomes the highest in case the fund is closed by the mutual fund company. The mutual fund company will close the fund only if the fund is not being profitable. So when the mutual fund company realizes the fund is not being profitable, so obviously the amount of money that the investor will lose in the mutual fund will be quite heavy. Now, there are options like when the fund is closed, either the investor can withdraw the money or the investor can transfer the amount to another mutual fund. So these options need to be looked at. But in general, when a mutual fund is closed, there is quite a heavy loss to the investors. Like I told you, since the risk is higher, the returns are also higher. The income from mutual funds is taxable in India. There is both short term capital gains tax and the one which will apply in the discussion that we are having right now are the long term capital gains tax, which will apply to the returns from the mutual funds. Advantage in terms of exiting the mutual fund is that we can exit at any point of time. At any point of time, I can say that I want to redeem all my units, and I can say I want to redeem part of my units and I can exit. Now, when we are exiting, we need to check the exit clause. Generally, there will be an exit load. The exit loads are defined in terms of if we exited in less than 6 months, this percentage will apply as exit load, or if exited in less than 12 months, this much will apply, or exited in less than 3 years, so much exit load will apply. So one needs to be careful and check out the exit clause of the mutual fund. Okay, so now we have gone through the instruments which we want to discuss, and like I told you, there can be other instruments which you can find out about. So now let's head over to Excel, where let's see how we can compute the most optimum manner in which we can put our money so that we are able to meet the target or maximize the amount of monthly pension that we can get from our investment. So here we are in Excel. Now we will do this in two parts. First, I will show you how to operate the Excel so that the people who are not too much interested in the technical details can be engaged and they can switch off after that is over. And the people who are interested in the technical details can hold on. and go through how this Excel can be built and how this Excel can be optimized. So let's start. So first of all, look at that we have to plan the instruments. Now I have put out 4 instruments that we have been discussing. Now the first thing is that for the post office monthly income scheme, the current rate of interest is 6.6%. This you can verify from the Indian Post website. So this is the rate of interest presently. Now from LIC, if you take a annuity plan, then the scheme called Jivan Shanti used to give a rate of interest of 3.64% in case the policy is taken in the name of the self and the spouse, and the principal amount has to go to the nominee. So this was the effective rate of interest which this policy used to give. This will be discontinued very soon. So you need to find out the next policy which LIC will launch or from any other private company, and what will be the rate of interest. The third is that we can invest in bank fixed deposits. Presently, in a private bank like Axis Bank, they give an interest rate of 5.5% on a 10 years fixed deposit. The interest rate is lower at HDFC Bank at 5.1%. The interest rate may be higher at nationalized banks like State Bank of India. So you need to find out the exact rate of interest. And from mutual funds, like a fund like HDFC Balance Advantage Fund gives about 1% return per month. So 1% return per month normally works out to around about 12.36% per annum. So we can say that it will give about 12%. So this is the first thing that we need to notice in the Excel. Next is that we plan what is the maximum that we can invest in a particular instrument. So the investment in monthly income scheme from post office is 9 lakhs. So we have put that. There is no real upper limit when it comes to annuity plans or fixed deposits or mutual funds. However, I have put a very large figure based on the amounts that we'll be discussing, and you can increase this further in case you are talking about much higher amounts. We need to find out, based on our risk-taking appetite, how much we would like to invest at the minimum in every instrument. It is obvious that the instrument which gives higher interest rate, if we put all our money in that, we will get a higher return. However, that may not be the best strategy, simply because the amount of risk that we will face is also going to be much higher. So to balance that, we may put a target for ourselves that we will at the minimum invest this much amount in each of these instruments. For example, I say that I definitely want to put 9 lakhs, that is a maximum limit, in the post office monthly income scheme. Then I can set that I will put a minimum of 80 lakhs in annuity plans from LIC, and I will put a minimum of 30 lakhs in bank fixed deposits, and I want to put a minimum of 20 lakhs in mutual funds. So having done this, we will get that the minimum that we are planning to invest is this much amount of money. So you can see here, if you add all these minimums, it comes to 1,39,000, 1 crore 39,000 rupees, 39 lakh rupees, 1 crore 39 lakh rupees. Now this amount has to be less than the total amount that we have with us at this point of time. So if you make a plan that we have 1 crore 20 lakhs right now, and we want to minimum make an investment of 1 crore 39 lakhs, this is going to become an impractical problem. So you need to balance it out. And so if I am having a plan of making a minimum investment of 1 crore 39 lakh rupees, then possibly I should make a plan based on the fact that I have, let's say, 1 crore 50 lakh rupees with me right now. Let's say this is the corpus which we have. Then I have made the formula here which tells me based on how much amount of money that we will actually put in each instrument, which will compute. This is not known to us at this point of time. We will compute this, how much money we should put in each instrument. If you put this much amount of money in this instrument, based on the interest rate, I should get a monthly income of this much amount of money. So this is the amount what we will get based on how much money we will put into each instrument. And then we know that in the monthly income scheme and in the annuity plans, we have no tax, so there is zero tax. However, in the mutual funds, we have a tax of 10% on the returns of the mutual fund as the long-term capital gains tax. And the tax on the returns from the fixed deposits is dependent on the tax slabs in which the person falls in. Now, this tax will become higher if the person has got an income more than the investment what we are talking about. So if you have any other income from any other investment, those income also will get to your taxable income and the tax will be much higher. So I have not taken into consideration all those factors. So I have kept the calculation a little bit simpler. However, it's quite detailed nevertheless. So based on these facts, we can compute how much of tax we will have to pay for the income that we will generate on a monthly basis. Tax is always calculated on an annual income. And then we can see that this is the amount of monthly income that we will get, and this monthly income translates to this amount in annual terms. We will have to deduct the tax to get what will be the net income we will have on an annual basis, and what will that net income on an annual basis translate to as a net monthly pension. So this is set up. We will go through, like I told you, all the ways to calculate all the figures. But now let's see, for a person who just wants the output, how much money he will get. So I will show you how to do that. So the basic problem is that I want to invest 1 crore 50 lakh rupees, and I have made a distribution of the amounts that I minimum want in each instrument. So I can say that solve this problem for me. So Excel has this option called solver, and I say I have set up the problem. I'll explain this to you, and I say solve. Now Excel is solving the problem for me. It takes some time because this is a linear programming problem, and this is reasonably complex because there are a lot of formulae involved here. It's not a very complex problem, but it takes a little bit of time. Let's see what it does. So it has made a solution. It says that we need to put 9 lakhs in post office monthly income scheme. We are told that we minimum want 9 lakhs and the maximum also was 9 lakhs. So we had no choice, but 9 lakhs had to go in here. And it suggests that we put the minimum amount that we planned in the annuity plan of 80 lakhs. We put the minimum amount what we planned for bank fixed deposits at 30 lakhs, and the balance it is suggesting to put in monthly in mutual funds. So these are the amounts what it is suggesting us to invest in the different instruments. Based on this, it computes that I will get a monthly payout of about rupees 5,800 from the post office monthly income scheme, about 36,800 rupees from annuity, about 17,200 from bank fixed deposits, and about 32,000 from the mutual funds. On the amount what I receive monthly, if I multiply this by 12, on this amount I have to pay a tax of 62,000 some rupees, and on the income from mutual funds, that is the amount into 12, that is 32,000 odd into 12, I have to pay a tax of around about 38,000 rupees. So we can see that there are different tax slabs, and on each tax slab we will have to see where we fall, and based on that the tax calculation is done. So here we see that from this investment plan we would have got a monthly pension of 91,960 rupees. This translates to about 11 lakhs per annum. We have to pay a tax of 1 lakh odd on this. So our net income would be about 10 lakhs per annum, which translates to about 83,000 rupees per month. So if your target is that you require the amount which is 83,000 or little less than 83,000, then you should be happy that this plan works. Otherwise, you may have to choose to put in more amount of money to meet your target. So how this works is that you need to set your target. Let's say now I set the target that I have money of 5 crores. So I say that I have a corpus of 5 crores and I ask this instrument to give me the plan as to how much I should invest where. So I can tell the solver to solve it for me. Like I told you, it takes some time. So it is creating the solution. So there we have the solution, and the solution says that we should invest in this pattern. So it is obvious that it will tell us to invest in the instrument where the risk is much higher and the interest return rate is much higher. So to balance that, we can set the values differently. So I can change it and say put minimum 2 crores in annuities and put minimum 70 lakhs in fixed deposit. So if I solve under this circumstance, I should get a more balanced investment plan. The solution is getting created, and there we have it. So you can see that it is suggesting to make the investment of 9 lakhs in monthly income scheme, 2 crores in annuity, 70 lakhs in fixed deposits, and the remaining 2 crores 21 lakhs in mutual funds. So if you are happy with this, you can make the investment accordingly. Now we will go through how this Excel is set up for the people who want to get into the technicalities of the whole thing. Now we go through how we can set up this Excel for creating the computations that we have just done. So there is a reasonable amount of computation. So let's go through them. Now, first of all, we need to calculate the monthly returns, what we will get. Now, to calculate the monthly returns, we can use the formula PMT. So I will show it to you once again. So I can give the formula PMT. The first parameter is the rate, and I say that the person is retiring at the age of 60, so I say a period of 30 years. We need to give a period. This is in terms of years because the interest rate is taken as the annual interest rate. Then I need to give what is the present value. The present value is a expense because we'll be giving money. So when I have an expense, it is a negative value. So I should say 0 minus the amount which I want to put in as the present value. So this is sufficient. So when I enter this formula, it gives me the amount. But this is the annual amount. So I need to divide this number by 12. So when I divide this number by 12, I get what I will get on a monthly basis. So I can write the same formula for the remaining instruments as well. So I can just copy this and I can paste it here. So I get the monthly returns from each of the instruments. Now I know that the tax on post office monthly income scheme is 0. So I just put a 0 here and a 0 for LIC annuities also. I know that the tax on the long-term capital gains is 10%. So I can straight away compute this as the product of the monthly returns into 12 into 10%. However, this tax on mutual funds is applicable only if the annual returns is greater than 1 lakh. So I can put a condition saying that if the annual return, that is the monthly return into 12, is greater than 1 lakh, then apply a tax of 10% on the annual return, that is monthly return into 12. If the annual return from the mutual fund is less than 1 lakh, then the tax needs to be 0. So this is the formula we can enter here and this works well. Now, next is that based on how much monthly return I will get, I can compute what is the total monthly pension that I can expect. This is nothing but here I put a formula that this is the sum of all the monthly returns. Well, before that we just forgot one step, that is the total investment is nothing but the amounts what we will invest in each of the instruments. So this is the sum of all these investment amounts that we will invest in all the instruments. Now notice a trick here that I have put the amounts which we want to invest in one column. Then I have made another column which contains the round of this amount. This is because when we will optimize, it is quite possible that Excel will generate the numbers for the amounts to invest in fractions. And we may not want to invest in fractions. So we can round off the investment amount to the nearest non-fraction whole number. And this is the amounts which we can sum up to calculate the total investment that we are planning to make. Okay. Once we have got the monthly pension, we can compute the annual pension by just multiplying the monthly pension by 12. As you can see here, this is nothing but the monthly pension multiplied by 12. Now comes the tax computation part. So here we have the total taxable income. Now you must remember that there are a lot of income which you may have besides this also. So those also going as a taxable income. So you need to include that. I am not including that because I have no idea, first of all, regarding this number what you may have. And it is not possible, or it is not so necessary to make a hypothetical judgment regarding this. So I just take it as this is all the income that you have. And so I say that your total income is nothing but the total annual pension that is planned for you. Out of this, we know that we paid a tax of this much amount on the mutual funds. So I remove this tax from the total taxable income that we have got. Further, we know that as of now, there is a deduction under section 80cc for 1.5 lakhs. There are other deductions also which I have not considered, which you may consider, like for example, under other sections like 80G, etc. So you can consult tax consultant for a detailed calculation. And anyway, so you will have some income which can be shown as non-taxable, and these needs to be deducted. So from the total taxable income that is here, I remove the deductions and I come to the net taxable income. That is the income on which my tax will be calculated. So I have come to this figure now. Now I know that as per the latest income tax laws, which may vary from time to time, between 0 to 2.5 lakhs, I have to pay zero tax. So I can just put as value of 0 here. Between 2.5 lakhs to 5 lakhs, I have to pay a tax of 5%. So to compute this, I can put a formula here saying that if the total taxable income that is here is greater than 2.5 lakhs, I take the minimum of 2.5 lakhs and the difference of the net taxable income and 2.5 lakhs. So whichever of these two is lower, I take that figure and multiply it by 5 lakhs. So if you see in this particular case, since the total taxable income is 39 lakhs, if I subtract 2.5 lakhs from it, I get around about 36.5 lakhs. So which is definitely greater than 2.5 lakhs. So the minimum amount would be 2.5 lakhs. And on 2.5 lakhs, I charge a tax of 5%. So this is the formula here. The same thing, we know that between 5 to 7 lakhs, we have to pay 10%. So I take the difference of the total taxable income from 5 lakhs, and on the balance or 2.5 lakhs, whichever is lower, I charge 10%. So I compute like this for the next slab, 7.5 to 10 lakhs, which is at 15%, then 10 to 12.5 lakhs at 20%, then 12.5 to 15 lakhs at 20%, and greater than 15%, 15 lakhs at 30%. So I get the tax applicable at each of the tax slabs, and I compute the total tax, which is nothing but the sum of all the tax which is payable at the different slabs plus the tax we would pay for the mutual funds. So I get the total taxable amount. So the total taxable amount is here. It's just the amount that I've calculated. So the net income will be nothing but the total income. I could have used the different formula also. I could have just said this minus this. So I get the net annual income, and dividing the net annual income by 12, I get the net monthly pension which I can expect. So this is the setup of the problem that we have made, but we want to optimize. So let's now change some figures so that we can see the impact. Let's say I only have 1 crore 30 lakh rupees. I reduce my expectations because I have to set this figure to be less than the total corpus which I have. So now let me increase this number a little bit to make it better. So now my problem is set up. I want to invest 1 crore 40 lakh rupees, and I have distributed the minimum amounts, which amounts to 1 crore 29 lakh rupees, which is less than 1 crore 40 lakh rupees. To get the optimum solution, I need to use solver in Excel. So in solver, I can tell that I want to maximize my net monthly income. So this is the problem which I want solver to solve for me. That is, in B13 I have the net monthly pension. I want to maximize this. How do I want to maximize? By changing the amounts which I will put in the different instruments. So the cells B16 to B19 contains the variables where I will make the changes. Then I need to put the conditions. The conditions are that this amount per instrument has to be between the minimum and the maximum possible for that instrument. So I need to put two conditions for each amount. That is, this amount 9 lakhs or this amount which I invest in post office monthly income scheme has to be less than the maximum possible amount which is here in this cell, and this amount has to be greater than the minimum investment desired which is in this cell. So I need to put 8 conditions in this case because there are 4 amounts, 2 each for each amount, saying that this amount has to be less than this value and this amount has to be greater than this value. Further, I need to put a condition that the total investment amount has to be less than the total corpus which I have got. Now I could have put a formula saying that B3 is less than B1, but Excel has an error. If I do that, Excel cannot make a calculation. So what I need to do is that I need to make a separate cell. In this case, I have put it in the cell C3, which is nothing but the difference between B3 and B1. So I have just put a formula here which says B3 minus B1. And this value C3 has to be less than or equal to 0 for the optimum solution which we want to find out. So now this much is the linear program which we have set up. Once we have set up this, we can say solve this. So when I say solve, Excel starts to solve the linear programming problem. And you can see that in the bottom, it is making the solution for us. It goes through number of iterations. The people who are familiar with linear programming will be knowing that we have to go through number of iterations, and then it gives the solution. So when I get the solution, so you see here, it has made a solution for me where it says that I have to make a total investment of 1 crore 39 lakhs 99,996 rupees in this particular distribution. So if I do that, I will get a monthly pension of 87,350 rupees before tax, and on this amount I have to pay tax at the rate of 15%, which amounts to 92,441.96 rupees. So this is the tax, and when I subtract the tax, I get a monthly pension of 79,646.59 rupees. So that's the end of this whole discussion. Thank you very much for listening. I hope this was useful to you. Goodbye.